Hey everyone, welcome back to Corporate Decoder. Today, CRTD Incorporated just filed this S-1 registration statement, and I'm seeing some big red flags that matter. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing details a plan to allow existing shareholders to sell a lot of stock, potentially causing significant dilution and price drops. Created Incorporated, also known by its ticker symbol, CRTD is looking to register over 180,000 shares of its common stock to be sold by existing shareholders from time to time. This is not a primary offering where the company sells new shares to raise cash. Instead, it means the people who already own these shares want to sell them to the public. The filing states they want to register up to 180,030 shares. These shares come from a few places. Some are just existing shares, some are from converting old debt, like those convertible notes that were issued back in November of 2025, and some are from warrants. Warrants are basically options to buy stock, but since these are being converted on a cashless basis, it means the company probably isn't getting any money from them. The crucial takeaway here is the company itself is not selling any shares in this offering, meaning they get zero proceeds. This is important for understanding your investment. When a company registers shares for resale by existing holders, it is often a signal that those holders want to exit their positions, and that can put downward pressure on the stock price. Created stock is currently trading on the OTCQB. This is typically a less regulated market than major exchanges like the NASDAQ or NYSE. They did mention plans to uplist to the NYSE, but that is still in the works. Being on the OTCQB also means their stock is considered a penny stock by SEC rules. This penny stock designation means there are extra rules for brokers selling these shares. It can make it harder to trade and can deter institutional investors from buying. Now let's dive into the risks. The company flags that they are a development stage business and subject to many risks associated with new businesses. They've had net losses and a significant accumulated deficit. This means they are still in the early stages of building their business and haven't achieved profitability yet. This is a big one. The company auditors, Astra Audit and Advisory LLC, in their report dated May 3rd of 2026 stated, there is substantial doubt about the company's ability to continue as a going concern for a year from that report date. For context, companies like Bed Bath & Beyond or Tupperware have faced similar going concern warnings and eventually filed for bankruptcy. So this is a serious flag. They are also very direct, saying they are not profitable and may never be. This kind of honesty is rare and important to acknowledge when looking at an investment. Their operating expenses are higher than their revenues, and they expect this trend to continue. This highlights the need for future funding. This is a standard risk, but worth noting. They compete in media and publishing with everyone from big tech to smaller startups. This ties back to the current filing. A large number of shares being registered for resale suggests potential for significant selling pressure which could depress the stock price. Again, the penny stock rules can hamper liquidity and make it problematic for investors to sell their shares. They even plainly state that investing in their securities involves a high degree of risk and that investors could lose their entire investment. Now let's look at the financials. As of the 31st of March of 2026, their cash and cash equivalents were about $250,879. This is a relatively small amount for a public company. Their total capitalization, which is a measure of their overall debt and equity, was around $5.4 million. Even more concerning, their accumulated deficit, which is the total net losses of the company over time, stands at a staggering $277 million. This means they have a long way to go to reach profitability. Looking at their operational results for the first quarter of 2026, they reported revenue of $203,727. This is a decrease from the same period in the prior year. Their operating expenses, however, skyrocketed to over $12.5 million compared to just over $2.2 million in the prior year. This massive increase was primarily due to stock-based compensation expenses. They had a loss from operations of over $12 million. This picture from the financials is not pretty. It highlights a company struggling with profitability and facing a significant cash burn. The company states its business strategy is a diversified portfolio of businesses generating revenue across media and publishing with a focus on monetizing first-party data, intellectual property, and scalable creative assets. They operate through subsidiaries like Vocal Incorporated and OG Collection Incorporated. Vocal is a creator-focused digital publishing platform, and OG Collection monetizes archival media assets. They also mention a proposed business operations component which is pursuing acquisitions of established cash-flowing small and middle market operating companies. This strategy of rolling up businesses can be risky and relies heavily on successful integration and finding the right opportunities at the right price. This strategy is heavily dependent on their ability to access capital and execute these acquisitions smoothly. Now, for the people running the show, Jeremy Frommer is listed as the Chief Executive Officer, Chief Financial Officer, and Executive Chairman. He has a long history with the company and extensive experience in financial technology. Justin Maury is the Chief Operating Officer, President, and Director, bringing expertise in product development. The board has identified Peter Majar and Arthur Rosen as independent directors based on NYSE standards. The company also has established audit compensation and nominating and corporate governance committees among its board structure. Alright, let's tie this all together. Created Incorporated is in a tough spot. They are facing intense competition, operating at a loss with a negative going concern opinion from their auditors and a substantial accumulated deficit. The S-1 filing indicates a significant number of shares are being registered for resale by existing shareholders, which, combined with the penny stock status and the company's overall financial health, paints a very risky picture for potential investors. While they have a strategy of acquiring other businesses, their current financial situation makes execution of that strategy highly dependent on external funding. My primary concern here is the going concern warning. This is the most direct indicator of potential severe financial distress. While they're trying to grow and acquire other companies, their core business needs to show a path to profitability and positive cash flow, which is not apparent right now, especially with this resale registration potentially adding more selling pressure. What I'll be looking for next is any signs of successful revenue growth from their platforms and any concrete steps towards achieving profitability, rather than just relying on acquisitions and further financing. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Make sure you like, comment, subscribe, and check out the Discord in the description.